In the marathon of investing, the average investor has lost against all competitors for one simple reason. Don't believe me? Take a look at this study that shows the average investor sits at the very bottom of performance, behind inflation, oil, homes, international stocks, gold, bonds, and stocks. We should be on the far left of this chart, pulling 8 to 10%, but instead the average investor is eking out 2% returns on the far right. So why does this happen, and what is the antidote? To better understand what happens, let's compare the last 2 years, then I'll dive into how to prevent it. First, the 2022 end-of-year heat map looked like this. The S&P dropped 20%, and there were headlines everywhere focusing on how 22 was the worst year since '08. The average investor sees these headlines and responds on impulse. This is perfectly reasonable. You see your account drop, and you want the bleeding to stop. So you pull out your money. If you did this, you've got company, as nearly 40% of investors that were polled by CNBC pulled out money in 2022. The panic selling was the worst with Gen Z and only slightly better for millennials. 7 in 10 Gen Z panic sold and nearly 6 in 10 for millennials. But that's not the end of the story. 23 looks like this, with bright green dominating the scene. The S&P 500 at the time of this recording is sitting at over 26% year to date. So what happened that such a high percentage of millennials and Gen Z panic sold? Well, I'm going to start with the base assumption that they were investing in solid investments. That's a risky assumption, but this is not a what to invest in video. What happens is they didn't have the stomach for the volatility. Investing great Peter Lynch said that in the stock market, the most important organ is the stomach. It's not the brain. This highlights a fundamental problem that the average investor faces, and that is maintaining emotional discipline when dealing with market volatility. This chart of the psychology of a market cycle has been around for a while, but it's a great illustration. Over here to the left, we're desperate for some growth. It's been a while since we've had good news in the stock market, and we've seen a lot of red lately. Our portfolio may have just taken a beating after beating. As the market ticks up, we start with disbelief that this is the market rally and that this will likely fail just like the last 10 rallies. But as it continues to inch upwards, we move on to hope, where the rally starts to pick up steam. We're now thinking a recovery is possible. As it starts to snowball, we experience some optimism that the rally is real, and the optimism fuels the belief that it's time to get fully invested. The continued growth sends a thrill up our spine, and some investors start to feel so optimistic that they're considering borrowing so that they can use leverage to make even more money. It keeps going until we top off with absolute euphoria. Emotionally, we're so far removed from the last market downturn that we feel untouchable. We are investing geniuses and we're printing money. It feels great to be on top, and then we get used to it, so we become complacent when the market dips a little bit. We've grown comfortable with the successes that we've experienced, but the dip continues, and seeing our investments drop so quickly gives us anxiety that the strongest heartburn medicine can't cure. Many are holding on, battling denial about what is happening, white-knuckling it at this point, still firmly committed to our investments. But then panic starts to set in as the drop continues. We become bitter and angry that this could happen and look for someone to blame. The market is flat with no hope in sight, and we become depressed. And then in the distance, we see a hint of a rally, but we don't trust it because it's been so long since we've been able to see growth in our portfolio. We come full circle to disbelief that this next rally will be the one. This may seem dramatic as we jump from one stage to the next quickly, but it's real. This quick summary of the cycle of market emotions is compressed into a short little 60-second summary. But this cycle can be a year, or it can last 5 years. There's no telling. Even the great Warren Buffett talked about this in his 1986 letter to Berkshire Hathaway shareholders. In this letter, he writes that what we do know, however, is that occasional outbreaks of those two super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable, and the market aberrations produced by them will be equally unpredictable, both as to duration and the degree. Therefore, we never try to anticipate the arrival or the departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy and be greedy when others are fearful. Buffett acknowledges that time and severity of market cycles is unpredictable, and as a result, they cannot be timed. He accepts that fear and greed are contagions that take the market by storm. So what do you do? Very simple. For the vast majority of us, you dollar cost average your investments. You automate your investments with the knowledge and firm commitment that you're not going to alter them when the market draws back. Then you subscribe to my channel and you hit the like button so you can insulate yourself from the negativity of the market. There's something called negativity bias, and it's a psychological phenomenon in which an investor places more emphasis on negative information than on positive information when making trading decisions. Loss aversion is twice as powerful as the next strong investing phenomenon of euphoria. And if we think about it, it makes sense. We would all love to wake up and see our account double in size. Who wouldn't? That would be cause for celebration. But to think about your account being wiped out, your life savings gone, decades of disciplined saving just evaporating. That's an extremely hard feeling to manage if you don't have discipline and knowledge. So what is dollar cost averaging and why does it work? Take a look at this chart of the S&P 500 for the past 5 years. This purple line is a rough estimate of the average of your investments. You might be thrown off that I've put everything above the line in red and everything below the line in green. But stick with me. Everything in red is you paying a premium. You're buying a stock or a fund when it's up, so you're paying more. It's no different than when you go onto Amazon and see that the price of that item on your watch list is up 20%. You don't celebrate, you're disappointed that the price is up. In the same way, everything in green is you buying below the average price, so you're getting a discount. You're getting a great deal. You're happy. Notice these lines at the bottom that I've highlighted. When you're buying every month or every 2 weeks, you're going to have some good weeks or months where you buy at a discount, and some bad weeks, months, or even years where you buy at a premium. But you keep buying. That is dollar cost averaging. It's important to remember that a low point is not necessarily indicative of a bad year. If we take a look at this chart, this shows how no year ended up as bad as its lowest point. And in 32 of 43 years, intra-year drops at an average of 14% still ended up with a positive return. 3 out of 4 years with an intra-year decline still ended positive. This is the greatest opportunity when it comes to investing. Bouncing back is where you get those awesome gains. Take a look here at this analysis done on nearly 100 years of US stock market performance. When the market dropped 10%, the 1-year average return was 12.5%. 3 years was 34.5%, and 5 years was nearly 69%. After a 20% drop, the results are even better. It's not even until we get to a 30% drop that we see a reduction in returns by comparison. A 10 to 20% drop in the market is awesome, so relax, it will be okay. If the market drops, but you've automated your investing and every couple of weeks you're buying, no matter what, you're going to be fine. And this is what David Bach wrote about in his book, The Automatic Millionaire. If you haven't read it, I highly encourage you to. I read it over a decade ago and it really made an impression on me. Up until that point, I had been doing most investing manually. My 401k was automatic, but everything outside of that was whenever I had the cash. But a strange thing occurs. Whenever you leave something like saving money up to your whims, it becomes much harder. Ever since I automated my Roth IRA, it's been fascinating to see the account balance just steadily climb in good years and bad. You force scarcity on yourself even when the budget is tight, and paying yourself first becomes a top priority. Money will follow the path of least resistance. There's a ton of friction to doing something like setting money aside into savings or investing. If you put structures in place in your life to eliminate the friction, you'll find that over time, finding the cash to set aside for savings and investing isn't that difficult. Employers use this strategy when they automatically sign you up for a 401k. It's called psychological inertia, and it refers to the tendency to stay with a default election because there is no effort needed to make an alternate decision. Again, it's the path of least resistance. Dave Ramsey says that winning with money is 80% behavior and only 20% head knowledge. What to do isn't the problem, doing it is. I agree with this. There are tons of smart people out there with the wrong behavior. So we all have a problem to overcome. Either we force ourselves to manually invest with money we've set aside whenever we feel we have extra, or we do it one time and we promise ourselves that unless we're breaking glass, we're not stopping. We're not going to get weak or panic when things get tough. We're going to develop a stomach of steel that can handle anything. Additionally, numerous studies have shown that the average investor is absolutely terrible at timing their investing. Investors that do have the money set aside will often buy high and sell low. That is the exact opposite of what we should be doing. This results in performance that is often worse than setting your cash aside into a savings account. You heard that right. Attempting to time the market can get you worse results than stuffing money under your mattress or putting it in a low yield savings account. This is because the window to realize those great buying opportunities can be fairly small. A study of the Russell 3000 index of the 25-year period from 1998 to 2022 highlighted that $1,000 would turn into $6,300. But if you missed the best week, you'd shave $1,000 off and be down to $5,300. If you missed the best month, you'd shave $1,200 off and be down to $5,100. If you missed the best 3 months, you'd shave $1,900 off. And if you missed the best 6 months, you'd have lost out on $2,200. 35% of your returns would be lost just by pulling the money out from panic selling. Whenever I see dollar cost averaging discussed, there's always an engineer, accountant, or an analyst somewhere who likes to chime in that lump sum investing is better from a purely mathematical perspective. They are not wrong. Vanguard even published a study that agreed with this, stating that 2/3 of the time, lump sum beats dollar cost averaging. If you fall in the 50th percentile in a 100% equity portfolio in a 1-year investment period, lump sum would yield 11.94% and dollar cost averaging would yield a 9.58%. I generally dismiss lump sum investing for 2 reasons. The first is mainly because it's not applicable to the vast majority of people. It's uncommon that your average diligent investor is going to be in a position to lump sum invest for the vast majority of their life. It requires that you win the lottery, receive a sizable inheritance, or maybe get a large insurance settlement. If those don't apply, you as the investor would need to forego spending a significant amount of money at the beginning of the year to accumulate as much cash as possible and then dump it into your investments all at once. Unless you have a massive income, most of the upper middle class aren't dealing with huge sums of money. The second reason I dismiss lump sum investing is investing behavior has very little to do with math and everything to do with the habits. I discourage the average investor from accumulating money in an attempt to time the market. Dollar cost averaging is the investing behavior Goldilocks. It enables you to sleep well at night. You can take the path of least resistance. You can automate your life into millionaire status. But let's say you do decide to time the market. What happens if you decide to invest your money at the absolute best time versus the absolute worst time over the course of your investment career? That will be my next video.